Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Hello, welcome back to the Risk Intel podcast series. With me today is Beth Nilles. Beth, thank you very much for returning to the program.
My pleasure.
Beth, before we jump into today's subject matter around risk and control self-assessments, maybe just a quick reminder of your background, right? Because you've eaten, lived, and breathed this, and you do that now there at SRA Watchtower. But just a quick refresh on how you became such a fan, an expert of the RCSA world.
Yeah, so I spent my entire career in banking operations of one form or another, whether it be compliance or lending or whatnot. And you just live and breathe RCSAs in the operational world, evaluating your risk constantly.
And so now today at SRA Watchtower, you spend a lot of your time implementing some software, but also really sitting down in I'll say more of a consultative conversation with a client to understand what are they thinking, and you're sharing best practices in those conversations. So I think what I'd love to explore here today is in this area of risk and control self-assessments. Talking a little bit about methodology and calculations and why that's important and how people approach that. So let's kick off with a kind of a broad question here, which is, when you start a conversation like this with a financial institution, someone who is perhaps just starting to think about a calculation methodology, how do you help them start formulating their thoughts, and what advice do you give them when they're just starting to formalize their RCSA calculation methodology?
Normally, the first thing I say is don't overcomplicate it. It doesn't have to be trigonometry, right? This is just a way to put consistent. It's a way to put a consistent approach and view and a measurable way of looking at risk. So don't overcomplicate it. Look at your likelihood and your impact of an event occurring. So what's the likelihood that it'll occur? Or probability? I've heard it put that way. And then if it does, what's the impact? I mean, it could be something very serious, but if it's not likely to occur, obviously your risk is going to be a little bit less there. And then what's the control effectiveness look like? So it's like three basic parts of it are the way to start. Do you have controls in place to mitigate this? And keep in mind that you can very rarely 100% mitigate a risk. That's the nature of it. So, and it's just that simple. Don't try to make it more than it is.
That sounds like it's a piece of cake, right? Make it simple. All right. So why is it not always that simple? What are the challenges that the financial institution would face if they were trying to, define and then implement a calculation methodology around their RCSA, right? Those principles of the likelihood and impact and control effectiveness, on the surface, pretty clear and straightforward. But how do you go to that next level of actually trying to come up with a calculation?
So first you have to agree on a consistent approach. So
okay.
When you evaluate risk across an organization, so that's your first hurdle, right? This is global. This is not just this one little area. First, how do you identify what your top risks are? Well, it's like a big circle, right? So you start listing things and then you say, this is my top risk, but maybe it's really not. And as you apply the measurements to what you're gathering, all the data gathering, you begin to realize where your top risks really lie. So it's big. That's one hurdle. But the other hurdle is you have to have a consistent definition utilized across your organization, so that everyone is measuring on the same scale. So if you look at it in non-risky language, if I'm measuring with the metric system in my operations department, but I'm measuring in inches and feet in my, some other area, you're not getting apples to apples. So you've got to have that consistent approach.
How do you then ensure consistency and accuracy? Because that's
The first thing is
that's not easy. It's easier said than done, right?
much easier said than done because adoption,
Yeah.
communication, education, that's all part of it. So first you have to all agree to the definition, then you have to document it so everybody can rely on it. Then you have to train. For a lot of people in an organization that is known for being all about risk, you have a lot of people who don't really understand about risk. So you have to educate your staff and you have to explain to them what you're trying to do in terms they understand. And that way, as people assess their risks and their controls, they're looking at it through the same lens, through the same perspective. I learned very early on in my career, when you're working in a job and you're responsible for something, it is oh so important to you in your area, right? But as you pull back and you look at it globally, you realize that something that seemed urgent and extremely critical to you probably isn't in the scheme of things. So it's hard in that. And then as you put values in there, it makes it come more apparent.
So I certainly see that as a way of ensuring consistency and making sure you've got accurate results, right? Agreeing on that definition so everyone is clear, right, what the expectations are. There are a couple of challenges though that go beyond just accuracy and consistency, and this whole question of subjectivity and qualitative inputs, right? It feels right in your example there, whether it's centimeters or meters or inches and feet, right? Those are quantitative data, probably pretty objective, but it's not always that easy, right? There's a qualitative aspect to here as well. So how do you balance the qualitative and the quantitative?
That's an excellent question. You do a hybrid approach at first. You start with honestly your gut. You've been doing a job for a while. You know where the risks lie. You might be able to not put definitions and parameters around it, but right? So you go with that, but you then start to gather data and you put that data in there and then you measure it and you look at them side by side and you say, well, my gut is saying this, but my data is only saying this. And you find the marriage of those. You find the balance of that. But going with your gut is valuable, but data is also very valuable.
Can you perhaps turn this from the theoretical to the practical and give us an example of situation where implementing a methodology, an RCSA methodology, was really helped a bank transform their RCSA process?
I would, except generally, in my experience, there is no RCSA process until there's a methodology.
Yeah.
I will say, you do find some people put spreadsheets together and they put colors on things, but if they don't have a true rating value system in there and it's used across the board consistently, you don't really have an RCSA process. It doesn't really work. So I would say that developing that structure and communicating it and keeping it moving, that's the other thing. You can't do it once. It is a repetitive, ongoing, continuous feedback loop about your operation. And that's how you can use it to drive your strategy, to help your strategic ends. Identifying your holes and your gaps, closing them where you can, acknowledging them, and working around them if you have to.
I'm going to ask you for a second just to give us a visibility into the methodology that something like a watchtower utilizes, and to give folks an example. Right there's plenty of other methodologies that are out there, but can you just share a little bit about the methodology that is supported within Watchtower as an example?
Sure. We evaluate inherent risk by looking at the likelihood of an event occurring, and we do a weighted average in our world, and we say, okay, if this event occurs, it's going to be 40% of your inherent risk. The impact, however, is going to be 60% of your inherent risk. And we say, okay, together these two figures, your rating on the likelihood of something happening and the impact that it would have to your financial institution, the financials of your institution, or the reputation of your institution, are going to be weighted at 60%, and you get a nice inherent risk. And then you say, okay, what are your controls? And we weight those controls because we want you to put more weight on the ones that are truly impactful to mitigating your control. And then you evaluate how effective is it. And we do that by saying, does this, and I can't think of the exact terms right now, but basically you're saying, has this occurred since this control went in? Does it really mitigate the risk?
Right.
And you can add as many controls as you want, but in all honesty, most risks only have a handful, maybe 5 or 6 tops.
Yes.
And then we say you don't 100% mitigate things, but you can do it pretty far. We say you can't. We take a very conservative approach and say you can't mitigate a risk more than 2 levels. So if you've got something that's very high, we do rate on a 5-level scale because I think you get more impact that way.
Right.
Better than doing it on a high, medium, low scale. You can when you're starting. High, medium, low makes sense, but as you grow and you really build your RCSA methodology, you really want to get to the 5 levels.
Thank you. I appreciate that. I think hopefully it helps people again take this from the theoretical or conceptual down in the brass tacks there, and the the calculation methodology is secondary to the fact that there is a methodology itself, right? When we go back to the questions that we started with there as well, how do you get out of the starting gate, and what's your order of operations? Well, you've just got to get out of the starting gate, right? You need a methodology, and then when you have a methodology, right, then you can get into the questions of getting it right adopted and so forth. But you've got to have that methodology to start.
Exactly. And you have to remember that it's continuous. It's not a one and done. So when you start with the things that you know in your gut are high risk, and then continue to build on it, and to fine tune it and things like that. Risks change over time, and you need to be conscious of that as you're going through your day-to-day. And controls change over time as well.
Right. I think that those themes there, as I was jotting down some notes as we were going around, taking a consistent approach, right? Don't overcomplicate this. Get yourself going, but have a methodology, and then agreeing to that the definitions, documenting them, training and educating, right? That's how you really are going to get people to lean into this. Starting, as you said, right? Your gut is a fine place to start, right? You've got to start somewhere. But then very quickly, you've got to get data into the mix. And then, as you said at the end there, I think that probably most importantly is that it's not set it and forget it, right? This is living, breathing, continuous, iterative, and making sure that you go through a process of maintaining this over time. So some great themes for people to think about there, Beth. Thank you for helping us think about this concept of calculating an RCSA methodology. And hopefully we'll have you back to talk a little bit more about then putting this into practice when in implementing an RCSA process or tool, which I think is the next step on this journey.
Sounds good. Thanks, Ed.